HUYA and DOYU had a rough time in the last 12 months and are currently down 80 to 90% of their all-time highs. They continue to dominate the Chinese game streaming sector, but are they viable investments? In this video, we will take a look at some recent news and talk about what can happen in 2022. If you want to find out more, please smash the like button and let's dive in. If you haven't heard of HUYA and DOYU, I'll give you a quick recap. The two companies are giants in the Chinese game streaming industry, with HUYA being the bigger one. However, they both comprise roughly 70 to 80% of the market, which is massive. Both companies have Tencent as their majority shareholder, which owns 37.2% of DOYU and 47.2% of HUYA. Most importantly, the biggest thing about HUYA and DOYU is how undervalued they are. DOYU has a market capitalization of $723 million while having no debt and $950 million in cash, while HUYA has a market capitalization of $1.3 billion with no debt and $1.76 billion in cash. Basically, both companies are trading for less than the cash they own. In the case of DOYU, the company is not profitable, so they're slowly burning through it. But HUYA is actually profitable. HUYA does not make massive profits, but they do make profits, and my point here is that HUYA is essentially trading for free. Here is where the big question arises: why are both companies so cheap? There are a few reasons behind that, most likely. First of all, the expectation here is that neither DOYU nor HUYA will be able to become consistently profitable in the next few years. That shouldn't be a problem if they were growing. But, by the looks of it, both companies have reached a plateau and their revenues are flatlining, or, in the case of DOYU, actually falling. This is both DOYU and HUYA's biggest problem. If they cannot make their business model viable and profitable, they simply won't make it in the long term. HUYA is actually the more viable of the two, but it is still facing some serious problems. On the other hand, DOYU's business has suffered so much that there are now rumors that Tencent will be taking the company private. In fact, I think this is looking very likely. Why? As I said before, DOYU is trading for less than the cash on its books, meaning that the takeover by Tencent will actually come out cheaper for the tech giant. Plus, given that there is pretty much zero likelihood that DOYU and HUYA will ever merge, this looks like Tencent's most logical move. Second of all, there was a lot of scandals and problems around the actual financial structure of Chinese companies that are listed on US exchanges. Long story short, investing in the ADRs, which stands for American Depository Receipt, of DOYU and HUYA essentially means that you invest in a shell company in the Cayman Islands, and that comes with a lot of risks. Just look at Didi and Luckin Coffee. There are plenty of scandals, scams, frauds, and so on that can happen with Chinese companies. And, as a foreign investor, you find yourself in a very bad spot if that happens. No individual foreigner can own shares in a Chinese company unless you buy into one of the few institutional funds that can legally invest and buy Chinese shares. Now, it looks like the new regulations for Chinese mainland companies that the SEC put in place last year are now being followed because there has been a new Chinese IPO on Wall Street, Meihua International Medical Technologies. Still, the backlash last year appears to still be priced in to DOYU and HUYA. Third of all, the Chinese government cracked down on the gaming sector almost half a year ago as part of its new 10-year plan. Unfortunately, the gaming sector has not really recovered, and from the looks of it, the new laws that the Chinese government implemented are here to stay. What that means is that HUYA and DOYU need to get creative if they want to stay afloat. Again, this is another reason why Tencent will likely take DOYU private. DOYU was struggling before these new restrictions, and a takeover from Tencent is DOYU's way out of this. So, what does Wall Street think of DOYU and HUYA in 2022? Well, out of 10 analysts, 7 give DOYU a hold, 1 gives strong buy, 1 gives buy, and 1 gives hold. When it comes to HUYA, the picture is a bit better. Out of 16 analysts, 6 say buy, 5 say hold, 2 give it a strong buy, and 3 give it a sell rating. The average price targets for both are relatively high, with $3.88 for DOYU with a current price of $2.23 and $9.89 for HUYA with a current price of $5.57. However, what about revenue and earnings? Well, HUYA has seen 11 down revisions for their 2022 revenue expectations, with 0 revisions up. HUYA has also seen 4 down revisions for their 2022 earnings, with 2 revisions up. DOYU has seen 6 down revenue revisions and 1 up, with 2 down earnings revisions and 3 up. Overall, this tells us that analysts expect both companies to do worse this year, and that is not good news. What does this mean for the price though? Well, low expectations typically translate into a low price. With the overwhelming analyst opinion being that HUYA and DOYU will underperform, I can't see the price going up by more than 20% until we see some good news and good metrics from the companies. Before you say that this also means that we can benefit more from earnings and revenue surprises, well, I don't think so. Not in this case. When HUYA released their last earnings, they beat expectations by 100%. What happened to the share price? We saw a 15% rise up in the few days after that, but then the trend down continued. As they say in investing, the trend is your friend. In this case, the trend is not DOYU and HUYA's friend. I will still keep monitoring the stocks as they do have a turnaround potential, but I'm not putting my money in them until I see some good news. What do you think? Are you bullish or bearish on DOYU and HUYA? Let me know in the comments below. If this is your first time here, please like, subscribe and share the video to share the love. Thank you for watching and I'll see you again soon.